As an investor, your first priority for selection of an asset mix would be to choose a residential house. Next comes sufficient insurance cover with short-term liquidity needs. Then, the asset mix decision consists of choosing the proportion of investment in equity and non-equity investments. Your portfolio will have to be blended by choosing the correct asset mix, your correct liquidity requirements and tax considerations, and to reduce the risk over your investment horizon. In other words, when you choose your asset mix, this depends on your financial position and your temperament. In this context, investment objectives are specified in terms of risk tolerance and return requirements. Whatever is your asset mix, there are some inherent constraints that arise out of liquidity, risk, and investment horizon considerations. You must know that there are two strategies of entry and exit for your chosen portfolio. The first strategy is the active strategy, and the second strategy is the passive strategy. In the active strategy, you will assign a task to a portfolio management professional who will choose your portfolio of stocks and other investment opportunities like mutual funds and government bonds. There is a hope to beat the market and you becoming rich by getting good returns. It is to say that there are no guarantees that you will make good profits. Sometimes you may feel happy that a certain stock has given profits, and next you get disappointed with a loss-making portfolio. So this is the risk factor under your active strategy. For your passive strategy, you will invest in an index fund. Just lay back and relax. The index fund just mimics the movement of the market indices instead of outperforming them. You exit when you feel that the risks become too high. This strategy has a relatively less risk factor. The returns may be high to moderate depending on the performance of the market. Portfolio analysis considers the risk and return that an investor may expect from holding a mix of various individual securities. Building a portfolio of stocks and bonds require a good amount of research. Gathering of reliable and dependable information is crucial for this purpose. A well-diversified portfolio will reduce the risk of making any losses. An optimum portfolio that an investor can build will be one that maximizes return on your investment. An investor not only needs to assess the returns of individual securities but also will associate the risk with the performance of the whole market. This will minimize risks ahead of the market movements. Another important area is to merge your portfolio planning with the identifying of undervalued stocks whose prices will recover and overvalued stocks whose prices tend to be more volatile. Portfolio evaluation holds an equally important role as securities evaluation. For example, an investor is able to sell a stock that has risen by $14. He uses the capital to invest in a new and profitable security. On scrutiny of the security prices, the investor finds that the price of the share he sold has increased by another $5. The potential earning of $5 that the investor lost can be considered as an opportunity cost and not as a loss. This happens because the investor considered the whole portfolio rather than a single security. Holding on to a falling stock, especially when markets are falling, with the expectation that it will rise in the future, can lead to loss making. This happens because the tendency of the investor is to book profits. An investor does not prefer to book losses when buying and selling shares. A better opinion in this circumstance is to opt out of the holding and purchase the stock which is more profitable. The objective of portfolio planning and designing is to achieve proper proportion of each of the holdings so as to reduce the risk making loss and to earn a profit. Perhaps a good way to arrive at this situation is to find securities which tend to perform well when others do not. This will ensure a more reasonable return for the portfolio as a whole, even if one or few of the components happen to be too risky to hold. The need for portfolio monitoring and revising arises. This is because portfolio performance never remains the same and becomes inefficient over time. Investors' preference for risk and returns change over a period of time. So, how do we measure portfolio performance? The risk is measured by variance and beta factor, and the risk of return are measured by the arithmetic mean, the internal rate of return, and the geometric mean. Evaluation of a portfolio of investments is necessary for individuals, firms, for mutual fund firms, and also for academicians and researchers. Though the objective of research will naturally be different, the method of evaluation is the same for all of them. Given here is an explanation of how portfolios are evaluated. When we consider the long run, the cash flow rate will need to be timed. This is because there are cash flows in the long run. Therefore, greater care will need to be taken to evaluate the portfolio return in the long run. The rate of return is precisely what we call the internal rate of return. We now become familiar with the concept of beta. The responsiveness of the price of a security with the market force is called the beta of the security. The more responsive the price of a security to the changes in the market, the higher is its beta. The beta for the market is the average return for a large number of sample stocks such as the Nifty 50 and S&P 500 stock index. The beta for the overall market is equal to 1. The beta for individual securities is calculated by relating the returns on the security with that of the market. Betas can be less than 1 or more than 1. Normally, the beta for a security is positive and lies between the value of 1 to 1.5. Beta is useful to investors. Beta helps to measure the impact that market movements have on the expected return. This is clearly illustrated with the example given here. Beta of a security shows how the price of a security responds to market forces. The capital asset pricing model uses a beta to form a link between risk and return. The capital asset pricing model provides a platform where investors are able to assess the effects of their investments in a security. The investors are able to calculate the impact that the investment has on the risk and return of the security portfolio. The capital asset pricing model reflects a positive mathematical relationship between risk and return of a security. The relationship is expressed in mathematical terms as given below. The required rate of return on investment is equal to the returns expected in a risk-free investment plus the security's beta risk, which is multiplied by the average return on all the securities given by the stock indices, minus risk-free returns on risk-free investment. Therefore, the higher the beta of a security, the higher will be the required rate of return of a given security. Whenever a new security has been added into a portfolio, it impacts the overall performance of the investor's portfolio. Using the mathematical relationship given by the capital asset pricing model, the investor can ascertain whether the returns of the new security are matching with the required rate of returns.